So, I mean, obviously, we don't want to make a tremendous amount, about a few days worth of choppy downside action in the markets. But I wonder what you think it might reflect just about the starting point for 2025 in terms of market field position, valuation, concentration of the market.
Well, it's too soon to say because we're only one day into trading in January. But that old adage of as January goes, so goes the year, there's some validity to that. Some people extrapolate that into a weak December, suggesting something about how at least the first part of the year is going to unfold. And there hasn't been a strong correlation in the past. In fact, periods where you've had a weaker December and then a stronger January have actually been followed by pretty decent market returns. So I think it's a little too soon to tell. I think the setup for some of this weakness was probably very sentiment driven. We had really gotten to a lot of frothy conditions in the aftermath of the election, that post-election rally period, especially when we went back into that concentration problem. Top 10 stocks are now 39% of the index. And I think that was the setup for some of this weakness. I don't think there was really any kind of prime catalyst. I think it was a little bit more of an exhaustion from a sentiment standpoint.
Yeah, and actually to that point, I should point out that, market breadth is actually okay today. It's about 50-50. It's not skewed to the downside. It is the large mega caps that are weighing on the index. And obviously that's a little bit of a shift, as you say, from December. Do you think that the sentiment reset is pretty much complete, or it kind of did what it had to do here? I guess I ask because I'm still seeing some of the smaller kind of story stocks move quite a bit. You did see a bit of rekindling in crypto-related stocks today.
Yeah, I think that there's still pockets of froth. The good news is that a lot of the froth you witnessed outside of just broad market type froth. So that's one differentiator, say, between the current environment and the late 1990s, where the froth has been a bit more concentrated, whether it's in crypto or, zero dated options or, bananas and duct tape a couple of months ago.
Yeah.
So I think that that's maybe akin to what we saw a couple of years ago when we saw it in the original meme stocks, we saw it in SPACs, and that's maybe a less frothy environment than one that is pervasive across the market. I think this is also part and parcel of many of these rotations that we've been talking about, these fierce rotations that happen within the market at the sector level, frankly, at times back into the darlings, the Mag 7 type stocks. And so I think that this is just a continuation of some of those rotations. And I think that's likely to persist at least the first part of this year.
Yeah, I guess in addition to just a general welling up of enthusiasm among investors following the election, you did also have this playbook that people tried to execute. Said, you buy cyclical stocks, you buy small caps. There was this template from 2016 and 17, but it seemed to really not have legs. And in fact, in December, industrials were down substantially, like 7 or 8% as a group. Banks also down a similar amount. I guess that speaks to what you're saying about these kind of violent rotations. But what's the macro message, if anything, as bond yields go up, for example?
I'd be really careful about ripping out the pages of the 2016-27 playbook and applying it to the current environment. I think 2018 as a playbook in terms of tariffs, how they get announced via social media, probably still has relevance. But the backdrop, particularly in 2017, was entirely different. Much more of an inflationary backdrop right now. There was the enthusiasm with regard to major tax cuts coming in 2017, which, of course, came to fruition at the end of the year. That's not on the table. Yes, you have the potential for an extension of the 2017 tax cuts, but that's not until end of year 2025. And in the beginning of this year, we're dealing more with the immigration policies and the tariff policies, which all else equal, it's hard to argue against them putting some downward pressure on growth and some upward pressure on inflation. So I'm not really sure that 27 playbook is an applicable one, given the current macro backdrop now and the key differences between now and then.
Yeah, I guess tax rates staying status quo in 12 months is not quite the same carrot that sort of held out in front of the market that it was back then. More broadly, though, in terms of how you would recommend positioning for this current environment, right? We talk about 2 great years coming into this. Obviously, valuations have been challenging, but hasn't stopped the market from going higher. Where within the market still seems like it's a relatively good deal?
So, Mike, as you know, we have been very factor focused, not instead of sector focused, but at least as an additive to sector based investing. With this rotation type backdrop, you're seeing huge week to week, month to month swings in terms of sectors and which ones are at the top of the leaderboard, which ones are at the bottom of the leaderboard. And I think that is a fairly tricky thing to try to navigate, even from a trading perspective. But there's been more consistency in performance at the factor level. And one shift, not that the world or the market thinks in pure calendar year terms, as if everything shuts off on the 31st and we, relaunch a whole new era. But from a factor perspective, as we think about over the next year, we still think you want to stay up in quality, focus on balance sheet oriented factors, return on equity and strong free cash flow, but also earnings-oriented factors like positive earnings revisions, that forward-looking positive trajectory, maintenance, if not growth in profit margins. But I think the one subtle shift that we may be in the midst of is one where level mattered last year. You wanted, strong versus weak in terms of balance sheet, high interest coverage versus low interest coverage on that factor. Now I think it's more rate of change oriented, where you want that leverage to any kind of improvement in the economy, especially if we can get back to an environment where the Fed is in easing mode. I don't see that very much near term, but I think that would be a force that might unleash some of these rate of change benefits accrued at the factor level while still staying focused on those higher quality factors. And the last thing I'd say is going down the cap spectrum, be really mindful of moves in longer term yields. We're not seeing the same tight correlation between moves in the 10-year and an index like the S&P or maybe even the NASDAQ. When you go down to the Russell 2000, you go down the cap spectrum into companies that have more variable rate debt and they've got tougher interest coverage backdrops. I think moves in the 10-year is really going to be the key to either outperformance or underperformance down the cap spectrum.